Would you pay money up front if it meant saving thousands over time? If you're looking to buy a home or refinance your mortgage, you've probably heard the term points thrown around. But what exactly are they, and should you pay for them? In the next few minutes, I'll break this down into simple, easy to understand terms so you can decide if buying points makes sense for you. And if you find this helpful, make sure to like this video and subscribe to the channel for more mortgage tips. 1. What are mortgage points? Mortgage points, also called discount points, are optional fees you can pay to lower your interest rate. Think of it as prepaying some of your interest up front in exchange for a lower monthly payment over the life of your loan. 1 point equals 1% of your loan amount. Buying points reduces your mortgage interest rate, which means you'll pay less in interest over time. The more points you buy, the lower your rate, but it costs money up front. Example: if you're taking out a $300,000 mortgage, 1 point would cost $3,000, which is 1% of $300,000. 2. How much can mortgage points save you? The exact savings depend on how much your lender reduces the interest rate per point. Let's look at a basic example. You're getting a 30-year mortgage for $300,000 at 7% interest. Your monthly principal and interest payment would be about $1,995. If buying 1 point for $3,000 lowers your rate from 7% to 6.75%, your monthly payment drops to $1,945. That's $50 in monthly savings, or $600 per year. After 5 years, you would have saved $3,000, which is exactly what you paid for the point, meaning you broke even. After that, it's pure savings. 3. Should you pay for points? Ask yourself these key questions. 1. How long will you stay in the home? If you plan to stay for a long time, paying points can be worth it because you'll benefit from the lower interest rate for years. If you might sell or refinance soon, you may not have enough time to break even. 2. Do you have extra cash up front? If you have extra savings, using some of it to buy points can make sense. If you're tight on cash, you might be better off keeping that money for closing costs, moving expenses, or an emergency fund. 3. How much will the points reduce your interest rate? Some lenders may offer a big discount per point, while others may not. Always compare offers before deciding. 4. Pros and cons of paying for points. Pros: lowers your monthly mortgage payment. Saves you money over time by reducing total interest paid. Can be a good investment if you plan to stay in the home long term. Cons: and requires cash up front, which could be used for other expenses. Takes time to break even, so it may not be worth it if you sell or refinance soon. Not always the best option, especially if interest rates are expected to drop in the future. 5. Final thoughts. Is buying points right for you? Buying points can be a smart financial move, but only in the right situation. If you have the extra cash and plan to stay in the home for several years, it can save you thousands over time. But if you're short on cash or might move soon, it's usually better to skip the points and focus on a lower upfront cost. Want to know if paying for points is the right choice for you? Let's talk. Drop a comment below or send me a message. I'd love to help you explore your best options. And before you go, don't forget to like this video and subscribe to the channel for more mortgage and home buying tips. See you in the next one.